I believe it's going to be similar to 2008, where it has a sharp recovery and then builds a launch pad, and then it screams higher, where you're going to $5, $7, $8, $12,000. And so this is ideally what I'm waiting for. Now, gold doesn't mean gold's going to pull back here, but what we're looking for in general, what I'm looking for as an investor, is for gold to pull back and consolidate. And I just want the stock market and the economy to cleanse itself, have that financial crash, which will probably pull gold down with it. And then as soon as we start to see gold firming up, then it's off to the races. That's when you get into gold, silver. You kind of load the boat up. These because this will be like the next major wave up. It'll be something like this or something like this.
Right.
Gold prices have recently retreated from their recent highs, easing after a robust rally that brought the precious metal close to a key technical resistance zone between $2,700 and $2,800 per ounce. This pullback coincides with a rotation of capital into riskier assets, fueled by a wave of short-term optimism in financial markets. However, market strategist Chris Vermeulen warns that this shift may be less about renewed confidence and more about tactical positioning in anticipation of potential volatility. Vermeulen notes that the current situation resembles the early phase of the 2008 financial crisis, when gold briefly fell before sharply rising as systemic instability took hold, indicating that a comparable pattern could develop now. Despite the softness in spot prices, physical gold demand remains resilient, signaling ongoing investor concern over the global financial system's stability. Vermeulen notes a marked increase in bullion purchases and a surge in secure vault storage inquiries, particularly from retail and institutional investors seeking protection against risks associated with traditional banking deposits. He interprets this heightened interest in physical gold as a defensive move, reflecting anxiety around rising sovereign debt levels, weakening economic data, and renewed strains within the banking sector. The disconnect between falling paper gold prices and increasing demand for physical metal suggests risk aversion is quietly intensifying beneath the surface. Looking ahead, Vermeulen maintains a strongly bullish outlook for gold's long-term trajectory. He views the current correction as a natural and necessary retracement within a larger upward cycle, potentially paving the way for gold prices to breach the psychologically significant $3,000 per ounce threshold. Vermeulen also highlights the sustained and record pace of gold accumulation by central banks worldwide, underscoring a strategic and deliberate shift away from reliance on U.S. dollar reserves toward greater diversification with tangible, hard assets. This movement reflects growing concerns about currency devaluation, inflationary pressures, and the geopolitical risks that continue to roil global markets. While risk assets may currently attract capital inflows, the global economy's structural challenges, including mounting sovereign debt burdens, persistent geopolitical uncertainty, and ongoing unpredictability in monetary policy, provide solid fundamental support for gold. Now, we present the clips from Chris Vermeulen's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
So there's a few layers. I want to start on the big picture of gold and then kind of zoom into the shorter term. So this is when the super cycle started back in early 2000s. We had the big run up all the way up into 2011, and then we've gone into this new correction, and we started a second or another super cycle in 2019. Now, what's really interesting here, Danielle, is Fibonacci theory is one of my favorite tools. Fibonacci is in everything in the universe, and I use it very often for price action to identify where something is going to move to. And if we take this first massive bull market, the super cycle rally, down to this low, and we just carry it over to the right-hand side, it's going to show us where the upside target for gold is. Now, this is something we were able to project over here in 2019. I said, hey, listen, now that we've started a new super cycle, the maximum target we should see is about 27 to 2,800. And you can see we hit that price. Now, what's also interesting is the newer super cycle that started in 2015, and it hit this level, and then it pulled back here. If we carry it over, both of these cycles are pointing to roughly the same price. And so those are rock solid levels. Now, what is really interesting here is each time we've hit one of these Fibonacci measured moves. There was another Fibonacci measured move over here. There was another one over here, another one right over here, and another one over here. And so you draw these levels as the charts are unfolding. And each time we've hit one of these levels, we've seen gold have this giant push up in this big rally. And each rally, believe it or not, has been 22 to about 24% to the upside. And that's exactly what we have just seen right now. So we're in this stage where gold tends to perform exceptionally strong and take off. It's hit our target. Anything after this really, to me, is like icing on the cake. We're like, okay, now everybody's piling in. People are really bullish on gold, so they don't want to sell, which means if people want to get in, they got to pay top dollar for it because the investors are saying, I'm not giving it to you until you give me a much higher price. And so I believe we're going to come into a larger financial correction that will pull gold back, very similar to the 2008 pullback, where gold, had a pullback of about 34%. So I think that's where we are. I believe we're like right here. We're on this little blow off phase for gold. The economy's rolling over. And I remember the world, everything seemed to be slowing and coming to an end. I actually sold one of my businesses, just before the market collapsed because things were slowing. I could see it coming. I'm like, you know what? Let's just exit this business. Let's sell it. And we can get into something different after a financial reset. And that's exactly what I did. So that's kind of where I believe we are right now, is this scenario in gold. And gold has put in these kind of tweezer bars, these little wicks that run way up and then the price gets slammed back down. It's happened twice. They generally signal a reversal type of pattern in the charts. Not always. Sometimes it will just indicate a pause. But once we've hit a 100% measured move and we've gotten into this blow off phase and we're seeing the stock market really struggle, the economic data is starting to struggle, gold is shining. Actually, one of the really interesting charts is check this out. So this is a very interesting comparison with gold. Right, so if we were to take a look at what gold did in 2008, so the stock market, which is the candles chart pattern here, put in more or less a double top. It had a big 20% correction. And interesting enough, we put in a double top here with gold, with the S&P 500. And we have seen gold shoot higher, just like it did in 2008. So stocks are topping and money's moving into gold as that defensive play. I told you, people are nervous about the financial system. They want to get away from the banks and all of that stuff. And then the stock market, as you'll see, eventually sold off and it crashed. The stock market fell 57% from the highs. And when we go into a bear market, it tends to pull gold down temporarily with panic selling. And then we tend to see gold will turn around and it shoots to the roof. So we have the exact same scenario unfolding right now. And the caveat here, or the one thing I should mention is everybody's going to be like, this is nothing like 2008. And I get that. Every bear market and every scenario is never really like the past one. The tech bubble was this very similar situation. Yeah. A bear market is a bear market. When you rip out the economic data and the news of what people think are causing the movements, and you just look at the price charts, price does, three things. It moves up, it goes sideways, or it goes down. And it's pure driven on fear. And so we're just at a point, doesn't matter what the reasons are, but people globally are getting nervous. They've been flocking to gold. The stock market's had its first 20% correction in this big bounce, just like it had a bounce over here before it rolled over and sold off. And this is a complacency type of move in the market. This is what I call a complacency move. And I believe we're going to see something similar here, where the stock market trades sideways for a while and people think we're starting a new bull market. But it's a very interesting scenario that the same setup is happening in the price charts like they did in 2008.
Gold has recently experienced a notable pullback of approximately 34%, retracing from its recent highs in a manner that aligns with well-established correction patterns typical of precious metals markets. Chris Vermeulen points out that this decline fits neatly within the parameters of Fibonacci retracement levels, a technical tool commonly used to predict potential support zones during price corrections. Based on this analysis, gold's price could stabilize around the $2,200 level, representing roughly a 38% retracement from the previous peak. Such a pullback should be seen not as a warning sign of a collapse trend, but but as a healthy and expected recalibration within an ongoing bull market. Historically, gold's price cycles often include sharp rallies, followed by significant but temporary corrections that clear out speculative excess, allowing for stronger and more sustainable upward momentum in the future. While it may cause short-term hesitation among some investors, this corrective phase is a critical mechanism underpinning gold's resilience and long-term growth potential. Vermeulen emphasizes that these pullbacks provide an essential opportunity for consolidation, enabling the market to digest previous gains and prepare for the next substantial move. Far from indicating weakness, such retracements often precede periods of renewed strength fueled by macroeconomic pressures, rising inflation, currency volatility, and geopolitical instability, which historically increased demand for gold as a safe haven and store of value. Let's get back to the video.
I think from a technical standpoint, when we look at, the financial markets are all linked in some way. So if one asset class is generally coming down, that money's coming out of an asset, it's moving into a different asset class. So for example, in the last, week or so, or actually a month or so, we've seen kind of money rolling out of gold, and it's been going into the equities market. So usually money is sloshing around between the various assets. Gold is to me is one of the key barometers, global barometers of that we're going to have a financial reset, not just in the United States or in Canada, but it's going to be global. And we're starting to see this. And obviously the tariffs have definitely kind of created the first shock wave that sent a shot across the bow to go, whoa, these markets can drop very quickly when something goes. But gold is telling us there's global fear. People are worried about another financial crisis, and gold is that way to protect your capital in terms of, even if you were to sell your assets and put them in a bank, that bank could be gone with all of your money. You could do the right thing and move to cash and protect yourself, but still lose all your money. So that's why we're seeing, I think, a big movement into gold, is because you're getting out of the financial system, you're holding physical assets, and more or less, it's kind of like an insurance plan. If things are going to go bad, you still have physical gold that you have. It's not a fiat currency. It's the real deal. And so I think that's, gold is going to be definitely a defensive play. And it has been right now. We're definitely seeing money move into that. So if we were to just look at this financial reset, and this is 2008, the stock market started to sell off. When people panic, they start to sell everything, even the good investments like gold. And there's also margin calls, which force liquidation. And gold's a pretty small market, so it gets pulled down with the selling pressure. But you'll notice gold bottoms out months and months or a year before the stock market will. It'll bottom out, and then of course it'll be off to the races and want to shoot up dramatically higher. And gold is going to be that safe haven play. People are going to start to say, okay, everything is falling, get me out. I want to move into gold. Get me, it's the natural tendency of, what people go to. They're like, nothing's good. Gold's going to be holding up percentage-wise, probably better than everything else. And so that's where people are going to want to move into. And especially when it starts to run, then it's just going to be that play that everybody's like, I don't trust the stock market anymore. There's still a lot of people out there that hate the stock market because of their experience of 2008. And it's moved people permanently over to gold. So gold is that it'll always be worth something. Generally, it'll be worth more. And the perfect example, Danielle, is we had the power go out in Canada, or the internet once. Pretty much all of Canada was out for a day. And I went into town and I sat at this cafe, which had a different type of internet connection. We've got like 3 or 4 major internet providers, and the main one went down. And I'm sitting there trying to do my morning report and analysis. And this guy says, hey, Chris, how's it going? And he's like, can I sit down and talk? And he was a fund manager. And he goes, you won't believe what I just did. He goes, I went to the gas station, and he had 2 silver rounds on him. And he says, I filled my car up with 2 silver rounds. You couldn't pay with credit card. Their systems were down. And when push comes to shove, gold is the ultimate currency. When you don't have any power or internet, you can still pull out a little brick or a piece of gold or a round of silver, and you can buy stuff. And
I just did a whole segment on that. It's crazy you mentioned the story. Please.
Yeah. No, it blew my mind. And I've got gold and silver all around me.
Many analysts anticipate that gold is poised for a significant resurgence as global economic uncertainties mount. With inflationary pressures persisting and traditional currencies facing challenges from debt levels and policy shifts, investors increasingly turn to gold as a reliable store of value. Limited new supply, combined with rising demand from institutional and individual buyers, is expected to create a tight market that supports higher prices. This environment sets the stage for gold to reclaim its role as a critical asset for portfolio protection during turbulent financial times. Moreover, ongoing geopolitical tensions and potential disruptions to global markets could further enhance gold's appeal as a safe haven. As confidence in digital and fiat currencies fluctuates, gold's tangible nature and long-standing history as a wealth preserver position it uniquely to benefit from future market shifts. That's it for today. Share your thoughts on Vermeulen's analysis of gold price prediction in the comments section below. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.